Hello and welcome to this Forex Preview at xm.com. I'm Maria Bashardis, and joining me is Senior Investment Analyst Rafi Boyadjian. We'll be discussing U.S. CPI inflation data out on Wednesday and the potential reaction in the dollar. So Rafi, there's been a lot of talk about inflation lately. Some fear that President Biden's $1.9 trillion stimulus proposal is too big and may eventually lead to a burst of inflation. What do you think the monthly print of the Consumer Price Index is likely to tell us? Should we be concerned about inflation at this point?
Well, Maria, there's definitely a lot of fear about rising inflation. Looking at some measures of inflation, for example, inflation expectations, the 10-year break-even rate in the US, that's actually risen to 2.2%. That's the highest since 2014. And long-dated treasury yields are also rising. The 10-year and the 30-year yields have risen quite substantially. They've reached new peaks this week. And all of this is on the back of those expectations that if that $1.9 trillion stimulus package is approved, then that might be one step too far. Of course, we've had plenty of virus relief packages out of the US. We had around $3 trillion in March, April last year. Then we had that $900 billion stimulus in December. And so on top of all that, now we get another near $2 trillion package. Then there's fears that this may stoke inflation. We're really seeing the impact of this in the markets. We've got this reflation trade where bond yields are rising on expectations of more government debt being issued. And at the same time, stocks are rising as well because we've got all this stimulus, all this liquidity in the markets. So traders aren't being put off by rising borrowing costs. And also from what we hear from policymakers, both at the Treasury and at the Fed, Janet Yellen and Jerome Powell are pretty much aligned in their views that if we do see any spike in inflation, it's likely to be temporary. And even if it was to get out of control, then bringing inflation back under control is far easier than doing too little at a time of crisis where there's still some risk perhaps of deflation and also the long-term economic damage from the pandemic. So anything that the government can do in order to support the people and businesses, then they should do it. And we of course saw from last week's NFP report that the labor market has weakened and we did see a bit of a pullback in the dollar as a result of that. So the expectations for January as far as the consumer price index is concerned is that it's expected to come in at 1.5%. So that's well under the Fed's 2% target. But at the same time, it has rebounded quite substantially from those lows when the pandemic first started. So if we were to continue to recover, then that's definitely going to keep those inflationary fears alive.
Okay, so if the CPI numbers beat forecasts, what will it mean for the US dollar?
So the US dollar has pulled back quite a bit this week. We've got a bit of risk on theme happening, both on expectations that the full 1.9 trillion package will get through in Congress, and of course positive news on the vaccination front. But if we were to see inflation rising above expectations, then we could see a bit of a rebound in the US dollar. And now, of course, in order to see a sustained rebound in the greenback, we would have to see more evidence that inflation is really picking up, and also not just inflation, but other parts of the US economy. For example, the labor market, we see a rebound in upcoming jobs report. But definitely in the short term, if the numbers do beat the forecast, then we will likely see a bit of a rebound in the US dollar, given the extent of the pullback we saw this week after Friday's disappointing jobs report.
Rafi, thanks so much. And thanks for joining us at xm.com.